There are 3 Peters that you need to know in your life. Number 3 is my good friend Peter Lim, who wrote this book right here. Did a video with him. Number 2 is Peter Parker of Spider-Man. And number 1 is Peter Lynch. And keep watching this video to find out why. As usual, guys, not financial advice this video, and purely educational. According to experts, in 2023, there's a 60 to 90% chance of recession, and I'm sure you want to avoid that. Now, over the past 7 months, our FIRL Pro model portfolio has grown by 18%, while the market has fallen by 3%. Now, if you're interested in learning how we did it, we've got a special free training just for you on the 23rd of March. So go ahead and sign up in the comment section or the description.
Okay, MJ, your favorite person, Peter Lynch.
So my favorite Peter.
Yes, so he ran a fund called Magellan, fund under Fidelity, and he actually managed to turn 20 million to 14 billion in a span of like 30 years.
Yep.
That's actually very, very amazing. And he is also actually known for his humor. He's a very funny guy.
Yes, very witty.
I mean, in his talks and everything, he just try to like make the audience laugh.
Yeah. There's a 1994 talk, I remember. It's like one of the best.
Yeah, it's like you don't know whether is it a stand-up comedy or is it what.
Yeah, and the thing is, like, it's not funny to the point where like the investing message gets diluted. I mean, it's actually like educational. So go watch it. 1994 Peter Lynch talk. Just type it in.
Yes, and this is actually a thread by Common Stocks. So thank you, Common Stocks, on Twitter. I'll put the link in the description. So if you want to read the full thing, it's over there. But anyways, this is our thoughts on how Peter Lynch actually managed to make a 29.2% CAGR. Okay, so number 1, it is within your control. I believe this is another word of saying find companies or ideas around your circle of competence, or basically you just need to know, and also you need to know basically things that you can control.
Yes.
So for example, like, can you control inflation? Can you control interest rate? Can you control market crash? I believe all of this is out of our reach, and it is actually a waste of time to predict all of these things. Where's the direction? Where is it heading? And just focus on what you know. So
to add some context, right? I think corrections, which is usually defined by around decline of less than 20%. These are things that are very common. Peter Lynch shares a lot of stats, which I forgot already, but a lot of it is like, in his career, he has experienced something like 30 or 40 such corrections. So it's very, very common, and you shouldn't like spook you or anything. However, what is very interesting is that if you actually focus on implementing a very sound but disciplined strategy of buying companies that are undervalued, what actually ends up happening is that you will naturally be going into stocks that are less prone to either corrections or straight up crashes.
Yep.
Right. So ironically, yes, you're right. If you're trying to predict 10-15% declines and things like that, it's very difficult and it's a fool's errand. But what I've realized is that if you actually focus on the things that you can control, you actually end up sort of weirdly market timing also, but you're not trying to market time.
Yes. Yep.
So like Warren Buffett is really good at this, where sometimes in the 70s, in the late 1990s, he's not trying to predict a market crash, but because he has a very reliable and robust system of analyzing stocks. So when he goes through like 100 and 200 over stocks, right, in the span of, a few months, what he realizes is that out of that 100 stocks, let's say like 80 are not undervalued. So naturally, you're not going to be as invested, right? And guess what? When you're not invested, it will look like a market timing, but actually you're not. So anyway, that's just something I wanted to add.
Yep. That's a good point. And the second one is DYOR, which is actually just do your own research or do your own due diligence. Yeah. So you need to know, if a company that you're investing in, you don't know what they are actually doing, then you are basically just betting, you're gambling, because you're investing in things that you don't know. It's basically going to casino and just either throw dice and
Yes.
get your cards. Yeah. That's
So
it.
this is actually one of the most misunderstood quotes. Finally, it's so simple, right? But a lot of people use this as an example, right? Where he'll say, "Oh, if you know the company, buy it." So there's a caveat you need to understand here. A lot of people read this and, okay, if I know it, I buy it. Oh, Starbucks, I drink Starbucks, I buy. Oh, I use Apple, I buy Apple. That's not what he means. He actually clarified this in a later video once he popularized things like that. It's like, yes, you can investigate and look into what you know. But very important, people don't read the second part of this quote, which is know why you own it. Right? It's one thing to know what you own, Dunkin' Donuts, Padini, Telecom Malaysia, but why you own it. And people look at the first part of the quote and think that that's a shortcut. Oh, if I know it's a famous brand, yeah, it's probably good lah. Don't even need to do any research, all right? Sure win. Nestle, whatever.
Yeah.
And you buy. And, very often they don't get the results that they want because they don't know the second part.
Yes, exactly. And never borrow anybody else's conviction.
Yeah.
If somebody say it's good, doesn't mean it's good for you. So you need to find out yourself. Okay, number 3 is stock is business. And an important key to investing is to remember that stock is not lottery tickets. So yeah,
yes,
it's as simple as that. It's not numbers on your trading screen. It is actually a business that is running on real time. And yeah, you just basically need to find out what is the drivers for this business and what is the risk of investing in this business.
Yeah, I think this is a very simple, again, this guy has the most simple quotes, but the best. And this is the difference between, like real estate investing and stocks, right? There are no tickers for real estate. It's not, you can't log into your real estate trading account, right? And see, oh, today Kuantan Properties is trading it. You know what I mean?
Yeah.
So that's why real estate investors are a lot more diamond hands. They're a lot more like rational. But stock investing, which are businesses, stocks, generate higher returns than a property. But because of the volatility, people don't apply the same kind of thinking. And the quote is here to remind you of this.
Actually, I need to correct you on the rational thinkers on property investing because some people actually, they do get FOMO. So actually, it depends on how it's marked.
That's true.
So it depends on how people persuade you.
Yep.
Some people are very lazy to do their research. Then they just buy on recommendation.
Well, I was trying to defend real estate investors, but okay.
But those kind of mistake is, once you make that mistake, it's gonna be hard for you to climb out of the hole. So
correct.
But things about stocks is that at least you can bounce back easily because once you lost, you can always put in another money to invest.
Hey guys, if you're interested in building a 6 to 7 figure portfolio using the power of stock investing, head over to the comment section or the description to sign up for our free masterclass so that we share with you exactly how we do it.
Okay, the 4th point over here is about short-term market. So he said that just because you buy a stock and it goes up does not mean you're right. And just because it goes down, it doesn't mean that you are wrong. That's because in the short term, the market is a voting machine. That's, I think that is very true because you never know. I mean, it doesn't really truly tells you what's the value of that company haven't even generated yet.
Yes.
And then you see the stocks go up, right? I mean, that doesn't really tell you anything. That's just telling you that people are interested in that company. That's it. Yeah, the numbers are not shown yet. So I
agree. And it's more important to know, so going back to the old quotes, right, to know the company. And once you know the company, one of the things you realize is whether this is a company you can hold for a long time or not. So if you can know these things about the company, then you can actually take advantage of the voting machine. In the short term, right?
Yes.
Prices can be very crazy.
Yeah.
And I think really good investors take advantage of this. They realize what the value of the company is. And then they're like, hey, wait, it's like trading way higher than what I think it is.
Yeah.
Sell. For example.
Yeah. And that's actually, MJ pointed out something very important is that you need to know when to sell actually.
Yeah.
Yeah. If you're just buying it and then you hold it because you think that you're a value investor, then maybe you are wrong because you need to know whether is it really valuable at that price. Okay. The next point is, I think I didn't change it. It's actually signal, it's more than noise. So there's always something to worry about. You need to avoid weekend thinking and ignoring the latest dire predictions of the newscaster. And then basically you just need to sell companies when they are not performing lah.
Yeah, and yeah, I mean things like noise, dire predictions, newscasters,
or maybe even like analysts putting like sell calls.
For sure.
Yeah, those are all noises.
So the thing is, like, newspapers are designed like they want readership, right? And negative news always sells. So when you're filled with negative news only, then that will shape your thinking, and you'll always think. And somehow the human mind is a way to over extrapolate. So they'll have like, for example, I just started watching a Netflix series called on the MH370, right? It's pretty popular now. And a lot of people watch that and they're like, wow, see, this is why, Malaysia is going down the drain, because they weren't cooperative. But they, what I mean? But like, and then recently there was an aero train breakdown in KLIA 1 or 2, I can't remember, one of them. And then people say, wow, this is exactly Malaysia. And then they start saying, wow, go from that to this is why the country is going to be a third, like, regress and all that. But then when you step back and you look at the data, like, people forget that nearly $33 billion of value was added in 2022.
Yeah, exactly.
Right? In terms of GDP. And I put out a tweet, actually you can just put it here, that say, look, the entire country made nearly 130 billion ringgit. And you spend your time looking at noise and negative news. I'm not saying to ignore them. Obviously, the aero train breakdown is bad. Obviously, how the investigation for the MH370 wasn't the best. But you cannot extrapolate it. Just as in the other opposite, where people were extrapolating how glove companies are going to go to the moon.
Yeah.
Right. You have to have a certain balance and a certain center with the things that you say and read. Yep.
Exactly. I mean, another obvious example is that when our ringgit actually appreciates, nobody bother. And I mean, there's no news headline about it. But when it actually depreciates, that's where everybody say that the ringgit is useless.
Yeah, so it's standard, right?
Yeah. Okay, the sixth one is that you definitely make mistakes along your investing journey. And then basically what Peter Lynch said, that if you are good, you'll be right 60%. Or 6 out of 10 times. But you'll never be right 90%. So yeah, just because you think that you're doing very bad, but actually if you're making 6 out of 10 times correct, you're actually doing very decent already.
Yeah, Warren Buffett has probably made hundreds, maybe even thousands of investment in his lifetime. But he has gone on public saying that only 20 has essentially made all his returns. And then within that 20, a big chunk probably came from like 5 to 8, right? And this is very important because if you come through the traditional school system, what is 60 marks? What does 60 marks mean?
Barely pass.
Average. It's B. Right, or something like that, right? And that's seen as bad. What happens is that a lot of people, even the smart ones, right, they go into the stock market, then they realize that they can't get it right all the time. In fact, they are more likely to get more wrong than right. And they straight away assume that, they say the market is rigged, or they feel bad or they beat themselves up or whatever. But you got to realize these stats, right? Because it's a completely different mindset. It's not so much how often you get it right. It's when you get it right, how much money you make. And when you get it wrong, how much money. You can get 9 out of 10 times right? But if that one time you over-concentrated or you took leverage, it doesn't really matter that you got 9 out of 10 right.
Yeah.
Right? So in reverse, even if I know people who only get 3 out of 10, but they're making money, and they'll tell you why, because those 2 or 3 out of 10 that they get outperforms all their losses. And I think I've shared this before in very old videos, that when I first started investing my first year, I bought 10 stocks, right? I was up 2%. So if I ask you, 2% is nothing, right? But if I ask you, right, look, I made 2%, right? How many stocks out of the 10 I made money? How many stocks out of the 10 I lose money? What will your answer? What will your guess be?
My guess would be a lot of stocks will be at a loss.
right?
And then only that few stocks is your winner.
Yeah, so most people I ask, if they don't know the math behind it, they'll say maybe 50-50, 40-60, like that, right? Even like yourself, you said most of them are negative. So the stats for mine was 1 was positive. Only 1 was positive, right? And then I started investing in a year where the market wasn't too good, but you know, you just go to show you, right? Like it's surprisingly a forgiving business.
Yep.
Investing. Yeah.
It is. And it's a business that you can always learn from it.
Yeah.
Yeah. That's the best thing about stock investing.
But guys, before we move on, if you're someone looking to level up their stock investing skills and you need a lot more guidance, we do have a one-on-one program called the Mentorship Program. If you're interested, you can apply it in the comment section or the description.
And number 7, it is winners versus losers. Now, I think this one would resonate with a lot of people. It definitely resonates to me because some companies that actually went up 20 or 30%, right, doesn't mean that they are already overvalued already. Sometimes you just need to let it run, let it do its job. And then for losers, obviously, when you see that it drops, right, you don't want to wait until it drops 90% that you start to sell. Yeah. You want to find like signs that, or maybe you already know the signs. Yes. You're just holding on to the conviction that it cannot be that bad. Yeah. So
this is the psychology part of investing, right? It's beyond the technical side of things, really, which is arguably more important. And you can do all the analysis you want, but if you make the wrong moves, if you don't have the right psychology in the market, you're going to get things a lot wrong. Yeah. Now, there's a lot of things to say about this, letting your winners run and things like that.
Yeah.
But I'll just summarize it as quickly as I can. In general, and I'm going to give a number of 80 to 90%, people do not let their winners run and people do not cut their losers. The reason they don't let the winners run is because they see the profits and they'll start saying things like, well, it's now unrealized. I need to realize it to make it real. And they're afraid of, oh, it's up like 80%, or I need to secure it, right? Later, what happens if you drop to 50%? Yep. Which can happen, don't get me wrong. Then they don't cut their losers because they don't want the pain of losing money.
Yes. Or worse, they sell their winners to average down.
Yes, correct. So what I see in a lot of the good investors, one of the telltale signs, and this one you can actually see quite early, especially if you're already investing money. And even if you're not good at the technical side, right? If you're able to do this, right, you have a massive advantage. And I always look for people who can cut. Better yet, they can cut and then the stock goes up, they'll be like, but they just
go.
That is a massive, massive superpower. And that is something that luckily I was taught early on, that ability to just, you're down 15%, that 15% is maybe 15K, cut. That is a superpower.
Yes.
Because it means, right, that the emotions that the stock market can throw upon you, right, does not have control over you.
Yeah. So that is basically MJ saying the stock market is not controlling you, but you are actually controlling the stock market. So I repeat that. You just need to think about what's the meaning behind those words. Okay, number 8 is safe bet. So yes, if you think that stocks are gambling, Peter Lynch thinks stocks are actually safe bet, but only if you are actually invested for long enough to ride out all of the correction. And when you're actually in a desperation mode, when you see the market is tanking, right, you definitely sell for cheap. You always sell for cheap, no matter what. So basically the message is just to tell you that time in the market, it's better than timing the market.
Yeah. So this one needs a lot more context. And this, I would say, is the most 50-50 questionable quote that Peter Lynch has. You have to understand that he started his fund in 1977 all the way until 1990s. That was a period of bull market.
Yes.
Very, very good. So the data that he draws from will be based on that period. And it's very good. Now, to be fair to him also, he does draw data from like 100 years or several decades. So in his defense, it is still generally true. But here's the caveat. In the US. Right? And that's why understanding some basic macro conditions and of course the market structure of each company is very, very crucial.
Yes.
So in previous videos, I've already said that in the US, large cap companies can grow larger. and do better and dominate even further, which means that when you buy, let's say, an index fund, you are more likely to make money.
Yes.
Well, you can't outperform the other index, but they're more likely to do well, right, over time. In Malaysia's case, you really have to adjust because a lot of the returns are not in the large cap sector. They are in the smaller and mid cap sector. So this is very, very important. So if I can refine this quote in the Malaysian context, it will be timing the markets is better than timing the market if you are A, situated in the small to mid cap space, and B, the companies in the small to mid cap space have very strong fundamentals, have good management, have decent runways. It's not a business that's about to be disrupted and things like that. So I think that's very important. And of course, that you bought it at a good price.
Yes, exactly. So yeah, that's the context. Malaysia or US.
Yes.
Okay, the second last one is you have to learn accounting.
Oh, wasn't that 12?
No, 10. It's going to be 10.
Okay.
Yeah. So learn accounting, and the reason why you want to learn accounting is because, well, that is how you understand the language of business.
Yes.
Yeah, and if you don't know accounting, you never know why they are making this sort of decision. You never know what is cash inside the balance. You don't know what's cash flow and everything. So yeah, you definitely you cannot escape accounting. So
there's another legendary investor called Jim Rogers. Jim Rogers used to be a partner / protege of George Soros.
Okay.
And he said that, look, one of the biggest edge is to read the 10K, which is the annual report for the US. And he was saying something very interesting. Once you read the annual report, you are like ahead of 95% of people. And he said the reason is because most people don't read but the startling thing, most people not reading an annual report is not a surprise. The startling thing is that a lot of analysts on Wall Street don't read it. Right? And I have to admit also, I myself have invested in companies where I haven't read the annual report. So it's very, very true. And again, just reading the annual report just gives you some sort of edge.
Yep.
Yeah, and what are the key things to look in the annual report? The accounting. What is it trying to tell you, right? Are there smoke and mirrors? Do you just read the P&L, let's say, which is what a lot of people do?
Yes.
But they read the annual report, but they only read the P&L.
Yep, 100%. Okay, the last point over here, it's about the future. It's more than the past. You cannot see the future through a rear view mirror. That's I think when you're driving. Yeah, that's the back mirror. And the market is always forward looking. And yeah, you basically just have to spend more time finding the next the winners of tomorrow.
Yes.
Yeah, it's a very simple quote over here. So this example is like, I think we quoted this a lot of times already, probably like every single video, glove.
Yes.
So if you think that glove can make the similar average selling price as they did in 2020, I think you need to wait for I don't know how many years if there's another COVID even going to appear. So, or there's another round of lockdown.
Yeah.
Or maybe there's like lesser players in the space. So yeah, you have to fulfill all of these ingredients for it to happen. But whether it will happen in the future, that is very uncertain. So yeah.
So I'll just add to this quote by saying that even though the future is more important than the past, obviously, because you can only gain in the future.
Yes.
The further you look back in the past, the better you can understand the future. That's what I would say.
Yeah. It rhymes.
It rhymes,
it rhymes. It doesn't repeat, but it rhymes in the past. Yeah. Okay, and that's all of the 10 points that Peter Lynch actually shared. And yeah, I hope you guys learned a lot about that. And before you guys go, this is FIRL Pro's performance. So far, we have been performing double digits against the KLCI index, which is down 3 to 4%.
Past performance is not promise of future returns.
Yes.
Right?
Yep.
Yes.
If you remember that. But yeah, we try our best to beat the market.
To apply the Peter Lynch principles.
Yes, exactly.
And program.
If you want more information about FIRL Pro, you can just check out the links in the description or comments below. But these two portfolios, just to show you guys our track record So far, how we have we been performing? If you notice, there's a portfolio at the bottom, which is called the Telegram stock performance. Basically, those are stocks that we shared to our members in Telegram, but are not in FIRL Pro. So these are companies that have short-term catalysts that we must share to our members immediately.
Yeah, we can write a report.
Yes,
quickly,
exactly. Yeah. So yeah, and basically there's a very short runway also for them to make some quick money. Put it that way. And it has been doing quite well. And if you're still not convinced, there's a free sample for you to enroll. Basically shows you FIRL Pro and our SIB program. If you want access to this free sample, it's at the links. The links are at the description and comments. And also, if you want to know how we actually pick stocks for FIRL Pro, you can check out our big masterclass that is happening on the 23rd of March. So make sure you sign up. The free links are all in the description and comments. So that's it for today's video. I hope you guys enjoy it. Make sure you smash the like and subscribe button. Don't forget to follow us all of our social media, Instagram, Telegram, Facebook, all of those good stuff. They are all in the description, and see you next week.
See you guys.